Yeah, I think in general, why the symposium is important, one, for our clients to see, as something I talked about, is they want to make sure that we're staying relevant in this ever-changing world. So for our clients to come in, they have a lot of business issues that they have to think about, they have to deal with, and they want to know that we have things covered, that we're thinking about things and not just thinking about the mundane type things, but what's happening next. And we're thinking about what are their needs and what kind of business decisions that they need to make. In an uncertain world, they can come here and feel a little bit more certain about things such as we're doing the right thing, we're trying to do the right thing for their portfolio, trying to do the right thing for their participants, but also helping educate them along the way, as this is what we do on an everyday basis, and we really try to act as an extension of our clients' staff. Think of us almost as the vice president down the hall. They're eyes and ears on the street. With them coming here, that kind of just lets them in a little bit on how we think about things.
So we get a lot of questions from clients these days about the upcoming presidential election and what we expect will happen in the markets and as a result in their portfolios. So what we did today was really spend some time taking a look at where we are today in the polls, what's going on with the markets, and then gave some look at sort of historical market performance and elections and the different parties and whatnot. I think at this point, what's priced into the market is the markets expect that Hillary will probably win. And so I think if that happens, that's probably going to mean not much happens to the markets. I think that if Donald Trump wins, it's probably going to be more like a little bit what you saw out of the UK with the Leave vote, which is that would be a surprise to markets. So I'm not saying it's a good or a bad thing, but it certainly would be unpredictable or a surprise. And that's usually what causes volatility in the markets. We've had lots of elections come and go. I think a little bit the point is, every time we have an election, people say this is the most important election of all time. And inevitably the market sort of keeps on chugging along no matter who gets elected. So I do think there would be probably a little bit more volatility in the markets if Trump gets elected. That's only because that would be the surprise outcome as of now. But I think long-term, he's right that it doesn't probably matter all that much from a long-term perspective.
Yields these days, interest rates are very, very low. So we took a look at why are we investing in core in the first place with such low yields? It's because it still provides some yield. And we also projected out the future where yields might be and what core could return in such a low rate environment. And then we also took a look at what else core provides, diversification, principal protection. And then lastly, we projected out how yields might look like in different environments if the Fed were to hike rates, let's say once a year for the next 3 years, versus if we have no more hikes and the economy gets slower and does worse going forward, the Fed is most likely not going to do any further hikes. How does core do? So in those two scenarios, we take a look at how core performs in a rising, slowly, steadily rising rate environment versus a dropping rate environment.
After the Brexit happened, it really took markets by surprise. So it was in the news a lot following those first couple of weeks. This will be a process that takes time to evolve and to unfold. And we'll start to see that occur into 2017. So as we get further along, we'll see some more implications there. But based on our work, so it's a 2-year process. In terms of the U.S. economy, U.S. has very little exports that go to the U.K. So from a trade relationship, very little dependence on the U.K. So we'd expect minimal impact in terms of U.S.-based economy. The United Kingdom and the Eurozone have some really significant trade relationships. So the uncertainty created by the Brexit can really complicate that Eurozone recovery story. 2015 going into 2016, the economy had started to improve in that region, and this uncertainty can kind of complicate that story there.
As many of you know, active managers have underperformed, particularly since the financial crisis, and we've been getting a lot of pressure from our clients on whether they should retain active managers. So one of our takeaways today was you want your active manager to be active. You want them to be different than the index. You want them to look and perform differently than an index. And that's why you're hiring them. You're hiring them for their brain power. And so we really do look for managers that possibly have that high standard deviation, have that high tracking error. And then with that is to remember that the most important data point is a fee structure. And if there's one data point we would like clients to look at first when evaluating an active manager, it's costs. Our industry is not one where you often get what you pay for. This isn't a car, this isn't a house. More does not often equal better. So the more the fee structure is advantageous to the shareholder, meaning the lower the fee, the better, we would tell investors to look there first.
My topic was on real estate. However, instead of talking about the normal characteristics such as, NOI growth and occupancies that we normally talk about, I talked about demographics, specifically the millennial generation and how they've impacted real estate investments. So when you think about it, the four main food groups or sectors of real estate are industrial, retail, office, and multifamily. So each one of them has been impacted by the effects of millennials. So to your point about home ownership, the multifamily sector has been on fire. And a big reason for that is because millennials, not only just millennials, but millennials specifically, are renting for longer. And that's because a lot of them are delaying stuff like starting a family, having kids. But the more they rent and the less they buy, that drives up prices. So the question becomes, how long will that last for? Well, the good thing is that there's a lot of younger millennials about to enter the market, and those millennials are likely to continue that trend for a long time. So multifamily looks pretty good.
The topic was, is my return target realistic? And that's probably the most common question we've gotten from clients over the last couple of years. It's difficult to defend a lot of clients' current return assumptions right now, given what's happened in the capital markets, and just the greater trend within the industry is institutional clients, whether they be pension, endowment foundation, healthcare, or reserve funds, are taking their expected rates of return downward. Equity markets are up significantly, up 63% over the last 5 years. Yields are very low right now, so future return prospects are diluted, and it's really hard to justify some of these expected rates of return. So one of the features we put in our presentation today was comparing what a portfolio used to look like to get you 7.5% versus today. And the real takeaway is that if you want to continue to maintain a target rate of return of 7.5% or 8%, or just in line with what you've done historically, you have to take on a lot larger allocation to risk assets, which is going to create a lot more volatility.
I talked today about the power of ideas and the power of incentives, and how if you take a different look at things, in my case, a Freakonomicsy look at things, sometimes you see some different answers than what people might expect. And in particular, I spent a lot of time talking about the work that we did on terrorism, where we managed to tell a whole bunch of lies to the world for a long time, and we ended up tricking a bunch of terrorists into essentially admitting they were terrorists, because we put out the word through our books and through the tabloids in the UK that if you were a terrorist and didn't want to get detected, you should go buy life insurance from the bank. And indeed, amazingly, some terrorists were dumb enough to go and actually go buy life insurance from the bank. But more generally, my approach to the world is to look for the little nuggets, the things that are obvious, where are really hanging out there, but because people are so busy, because of conventional wisdom, people have trouble seeing those. If you want to do well, you have to have ideas. You have to think differently. And those ideas don't necessarily have to be about, the returns on your portfolio. It could be as much about how you interact with your clients, or make your decisions about who to hire. All of those are places where a little bit of thought, a little bit of creativity can make a world of difference.